Do you want to achieve wealth and passive income through property investing? PK Gupta helps a community of over 10,000 investors achieve passive income by buying top 5% growth and simultaneously positive cash flow property using data, without wasting months doing research, spending weekends at inspections, or dropping $15,000 on buyer's agents each time. So, if you're overwhelmed with information overload but don't want to drop $15,000 on buyer's agents each time, check out PK's website, consultingbypk.com.au, and learn to build passive income through data. This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Welcome to the podcast. Phil Tarrant, host of the Smart Property Investment Show. I had to think about that for a moment. It's surprising seeing that I've been doing this for about 5 years and I live, think, breathe, sleep, whatever, property. And as a highlight to record this podcast, I get to do it a couple of times a week, chatting with property investors, what they're doing, those people that help those property investors get into the market. And there's some really cool stuff happening in the background here at Smart Property that I'll be sharing with you over the next couple of weeks, including a very new and exciting proposition for those who are looking to secure mortgage finance and struggling, like all of us property investors do, to navigate the complicated, turbulent world that is the banks at the moment, and how mortgage brokers fundamentally can really help with that. So watch this space, some pretty exciting stuff going on, plus the relaunch of something within Smart Property Investment, which many people have been asking for many years, that we will be unveiling over the next couple of weeks. So tune in, check it out. smartpropertyinvestment.com.au is where it's all happening. But today we are jumping outside of the residential realm into the commercial realm. And most property investors at a point in time will start thinking about commercial property rather than residential property. And often one of the triggers will be the reflection or the analysis, interpretation of their portfolio. When they go, hang on a second, I'd like this to be turned into potentially a positively geared portfolio rather than negatively portfolio. And often commercial is a good driver for better yields that can completely transform a diversified portfolio that includes resi and commercial. Many times your accountant might go, hey, have you thought about commercial property? We need to fix the cash position of this portfolio. So there's many reasons why people start considering commercial. Most people don't start out in commercial property. They sort of usually evolve into investing in commercial property. And then you see many property investors start out resi, ended up with a more diversified portfolio of resi and commercial. And then as they go through their property journey, they load up in commercial and often let a lot of the resi stuff go to the side. And that's just part of the journey that many property investors embark upon. And for many also, it's their strategy. I want to get into that today, how it's working, who's doing what works well. I invite into the studio. He's the co-host on a podcast that I record every single month inside commercial property, which is pretty cool. Scott O'Neill, he's from Rethink Investing. I've pulled him into the Smart Property Investment Show. I'm going to pick his brain. This is on my turf, so I can be a lot more pointy with this one rather than trying to be friendly to Scott. Scott, how you going? You well?
Well, mate. Looking forward to it.
Yes. No, I do enjoy our monthly get-together. And if you haven't tuned into it, Inside Commercial Property, great podcast. We do it every month. It's on, just search for it in whatever podcast player you use. We sort of go deep into asset classes and all this sort of stuff, but also look at more of the aspirational part of investing in commercial as well. But I just wanted to change the tempo a little bit with this podcast, Scott, and do this. It's this Smart Property Investment Show, but I want to do a bit of a commercial approach. And for many people that might not be familiar with commercial investing, so maybe some of the 101 stuff around it, but it's not very often I get a brief, Scott, for my discussions. As a team here normally just let me sort of work out what I'm going to do along the way. But today they have given me a pretty detailed brief, and thank you guys. It's a great team here. Scott, you know them all, driving editorial and content within Smart Property Investment. But they've called you here the king of commercial property. Mate, I'm going to call BS on that, mate. Where's that come from? Did you load them up with this? Is this the new monkey that you want, mate, to be known by? The king of commercial property, Scott O'Neill, Rethink Investing.
Oh, mate, never heard that one before, but you'll take it. That's my day job, so won't shut it down.
Well, there we go. The king of commercial property. I'm not convinced. It takes me
I think
time.
Your teams are a little bit too friendly, mate, but I'll thank them anyway.
Maybe. But anyway, look, you know more than most, mate. So I'm only giving you a bit of a ribbing there. And having sort of worked with you over it's well over a year now on our specific commercial podcast. You certainly know your onions. But let's start at the beginning, Scott. You're an actual commercial investor yourself, aren't you?
Yeah, so like you mentioned, I started investing in residential for many years and went into the unit block market because I was always a yield seeker. I never bought into the buy a property, hold it for 30 years and hope that, the capital growth, would sell down and make me money. I wanted to kind of enjoy the cash flow instantly. It was almost like that afterpay model. And it was the unit blocks that did the job at the time. But quickly that dried up because the capital growth overtook them, the yields didn't catch up, and commercial was the logical next step. And went into the commercial market and I've never looked back. I've actually sold down about $3 million worth of my residential portfolio and used that plus cash flow plus business earnings to acquire. It's over 40 million in property now. So I've actually bought 20 million in the last 12 months. So a couple of shopping center type things and industrial property. And the reason I can keep going with this stuff is the yield is so much better. And that makes the banks happy. Every time I present a deal to the bank, it's a yes every time, as long as you got the deposit. But if I tried to do the same thing in residential, they'd probably laugh at me by now and say, your overall position is you got too much debt, you got enough properties. Like, it's just such a harder conversation. So commercial will continually, over the next X amount of time in my life, I'll keep doing it because it's like the hunger of the game, really. It's not just about reaching a certain number. It's just, it's a profitable exercise when you do it well. And that's where we're, forever trying to improve.
So as well as being, I guess you've got two streams to how you create wealth or generate income. One is obviously the work you do through Rethink Investing, which is a buyer's agency supporting both commercial and residential buyers, secure real estate. But then your other stream is being an investor yourself. So, you're presenting deals to banks where you're making money rather than losing money. So that is a big tick in their books. And did you sort of load up with one particular lender with all of, what do you say, you got 40 million bucks in property? Do you load up with one particular lender? You got that pretty spread around so they make them all happy so they don't know too much?
Spread around, and particularly in the last few months sorting out these last purchases, we've done a real big U-turn with banks. So NAB came to the party and offered some really good terms. So part of the deal was to give them the house I live in. So we removed that from ANZ, which at the time 3 years ago or 4 years ago when I bought the house, that was the best product on the market. So we've left ANZ, NAB's taken that over, and now Westpac is offering some really good terms for some other types of stuff. So I've got, a mix of everything. Like the smaller resi stuff, I've got them with Macquarie Bank, and then CommBank's in there for 3 or 4 properties. So it is a very diverse mix. And what are my goals over the next, once I'm done with this sort of purchasing spree at the moment, is just to let the dust settle, go back, revalue all the residential side, maybe sell off another 1 or 2 that aren't performing like they could in other areas, and then just clean up the loans as well, because I'm sure you have it with your personal portfolio, Phil. You've got all sorts of random bank loans in there that the interest rates crept up on you, and then, you can literally just refinance somewhere else and save 1% on your loan. And when you're talking millions of debt, that is a lot of cash flow you can save for doing very little.
Yeah, I'm down that pathway myself. And as I mentioned at the top of the podcast, I'm about to unveil a really new, exciting thing we're working at here at Smart Property Investment in mortgage financing. And one of the big things is going to be refinancing the whole Smart Property Investment portfolio, which we share on this particular show. So I've spent a lot of time working through that over the last sort of 9 months, just trying to, a lot of stuff coming off fixed interest into variables, negotiating with banks. And you go and tune into some of the portfolio updates I've done of recent. You probably hear me ranting about it if that's the sort of stuff you want to listen to. But that's hard work, right? Like when you got 20 something loans across a whole bunch of different assets with different lenders in different structures, at different rates, trying to manage that is a full-time job in itself. So simplifying is key. You don't want to, you want to be diversified in terms of your lender, Scott, but you don't want to be too diversified so it becomes hard. So there's a real secret to it, isn't it?
Yeah, it is. And I was really trying to think, I'm trying to think 10 years ahead, and sometimes it's hard to even do that because you don't know where you will be in 10 years. But I'm now at the stage of trying to work out like what assets do I really want to hold as I get into older age. And it's hard to pitch that, but because you've got to think about all types of economic environments. So you don't just think about the boom times like we are now. What about when a recession hits? What types of assets will protect you in those markets? And what size assets as well is a particular one. Like you don't only want, if you've got a $10 million portfolio, you don't only want 10 $1 million properties, maybe a couple of 3 million in there, or some of the smaller stuff might cause you more dramas or give you less growth. Or like it's a very hard one to actually predict, and no one really knows the answer as much as they'll tell you. They think they know the answer because the world will change. There's so much technology, changes over the decade. Banking rules will change many times over, even in the next 3 years, let alone the next 10 or 20. So it's about sort of really trying to picture that ideal portfolio. That's sort of where I'm at, because saving time is key. And I know my wife is very sick of our portfolio, to be honest, and especially because we just booked tickets to Greece next year and we're going to be overseas for 3 months. So it's a stress knowing that we've got certain properties that are sort of causing little dramas here or there, and we've got to clean them out, because otherwise it's not really a passive investment if it's not doing its job. So yeah, this is all this kind of, I guess, the ideal behind the portfolio, what you want to target. But that's sort of the goal for the next year or two, just to work out where we want to be with it all.
Yeah, we're in the same position. So sort of, you're talking about portfolio makeup there. And when you start out investing in property, you think you know where you want to be with it in 20 years' time. And most people go, well, I want to own this much property with this much debt on it and looking towards retirement, generating me whatever income. But as you go down the pathway, you start looking more critically at it and just going, more is not necessarily better. Sometimes more is more of a headache, particularly if you want a more passive investment. It's easier to manage fewer properties that are a higher value if their sort of makeup is right, as in they're generating money and stuff, and getting rid of those properties. But you need to go through it. Like you have to go through it as a property investor to build up some sort of scale. If you want a large portfolio, you've got to build up some scale to be able to give you utility for starting to invest in this stuff, which are longer term assets, and then selling down the foundational properties. And that's the way it works. But you can't orchestrate that at the front end of it. You just got to do it to start with, knowing that in 10 years' time, in 15 years' time, you're going to have to recalibrate your portfolio. As long as you buy the assets right at the front end, when you get to that pathway, you're much better. If you buy crap assets at the front end, guess what? You're never going to be able to have that opportunity to make those changes. Right, Scott?
Yeah. And look, it's a really good thing to think about. And this is not just pie in the sky type stuff. Like I know, I've talked to many of your listeners and they've got very large portfolios, and even the guys starting out with their first, like, if you're doing this from a young age or even a medium age and you plan to do it for the next 3 decades of your life, and if you do it well, you'll probably be in a position, where you've got a large portfolio. If you dedicate a lot of your efforts into this, by nature, you may do very well with it. So it doesn't hurt to think about this long-term goal of what are the assets, or, if you're 70 years old, what are the assets you want to hold until you're 90? And it may be 4 large assets, or it might be 10, it might be 2 very large. But then if you go not enough properties and you lose one of your tenants, that might, especially if you're carrying debt, you don't just want to own a Bunnings and then that goes vacant and then your next generation's ruined because they're trying to, deal with the damage. So it's a real balance, and it's not about just only buying the biggest possible asset, but I guess that's the thing. It's a work in progress for everyone individually. And think about this long-term stuff, because it gives you, I guess, inspiration to make the right decisions today. Even if you're on your first purchase buying a 300 grand house in a regional town, think about it in 20 years, where you want to be. And that will help you make better decisions rather than just buying now because the bank said you can get a 300 grand loan. And I know a lot of young investors, that's how they think. It's about, how do I get that next asset as quick as possible, rather than really planning it? And I'm guilty as charged on that one. I was the most impatient investor. I was taking side loans out to sort of fund the next deposit. Like I was redlining for many years, and it worked. But, if the market turned on me at the wrong time like that, it could have been a disaster as well. So there's a method that you should follow.
There's method to your madness, and, everyone needs to have their own appetite or relationship with risk. And you're a capable guy, you're a numbers-orientated guy, so no doubt you have plenty of redundancy in that. You probably were thinking about the what ifs if things go wrong. You're just fortunate that you're able to get through it. But, it's nice to sit here, and I'd say we're both sort of we're mid-stage investors. We've still got a good couple of decades each, I would say, as active investors, before we probably just don't want to do anything and just want to sit back and relax. So, we get to speak from the position of we've been doing it for probably well over a decade, right? But, and this people might be just going, oh, look at these guys, they're like monopoly dudes just talking about, they're bit there. You got to start somewhere. So you can't get absorbed or over obsessed with what you're going to be thinking like in 10 years' time, 20 years' time, 30 years' time. You've got to do the doing. And you see those people, they call it where you just procrastinate, where they just don't do anything because they're all the what ifs. What if this happens? What if this happens? You must see it with your clients. You just got to start. You got to do something, because if you never start, you're never going to get going. Yeah.
And look, a good example of sort of how I like sort of talking to my investors is, like, I'll use an example. So these clients of mine, they were having their second baby. They were really thinking about going down the residential route. They had an $800,000 budget. So you're not going to retire with an $800,000 purchase, but this $800,000 property, we found they wanted to go down commercial because they wanted to get their cash flow now, because it would help them with their situation that was coming up, where they would the wife was not able to work for a period of time. There was more cash flow pressures. So instead of going down and buying a 2-bedroom unit in Sydney or a house in Brisbane where you're probably negatively geared, they went and bought a warehouse. That warehouse was producing about 55 grand income, and their mortgage on that was about 20,000. So, you can see it's built them an instant passive income, and that was, $400 or $500 a week, plus, depending on rental management and stuff like that. But that's a really good start. If you can buy a property and it gives you $500 a week clear after mortgage, after rates, after everything, that's a genuine bonus for your life. And their instant thought is, how do I replicate this? How do we turn that to $1,000 a week passive income, and then $1,500 of passive income? And those incremental steps are how I invested initially. And it was slow going at the start. I bought 3 properties in 4 years at the start. And to me, that felt like forever, to be honest. But then the growth started happening, and, it all, deposits were getting created from capital growth. So things started moving quicker, and I was getting better at investing. So that, those little passive income goals were all I went for at the start. And it's a good way of thinking for a first-time investor, especially in this. I found that, like, ever since COVID hit, people's lifestyles have changed as well. Like, they value certain things differently. And that's where the commercial side is kind of quite ideal, because, you are creating an income that you can use, and it takes the pressure off work. Even if that passive income's high enough, everyone's got a different number. It doesn't need to be hundreds of thousands of dollars. Even if it's a couple of tens of thousands of dollars, that'll take the pressure off working 1 day a week for many, or 2 days a week. These are the little incremental goals that people should focus on, I think.
Yeah, that's the idea. And for you, the pivot to commercial was probably a huge sort of mindset shift, but also a shift in your wealth building capabilities, because banks view commercial lending different to residential lending, particularly for property investors. So I want to get into some of the nitty-gritty of commercial investing. We'll just go to a quick break. Stay with us. Back in a moment.
Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Scott O'Neill. Rethink Investing just shared his pathway as a property investor. And I know this is what our listeners really enjoy, how other people are doing it. It's very aspirational. They want to know, okay, if all this works and it's very mechanical and technical and lending and buying and all this sort of stuff, so what? What does it all mean? Let's put Scott in a position where he's largely able to do what he wants to do. And I think you work because you like working rather than you need to work, Scott. And that's probably pretty important.
Yeah, and it's the same with every single one of my investors. Like we've helped many guys that will literally never need to work again. Even before they came to me, they never needed to work, some of them, because they're running good businesses, or in some cases they've been commercial investors for longer than I've been on this earth as well. But they're investing because they love it, the game of it. It's but they don't stop working. I don't think I've met someone who's actually stopped working. The closest to stop working is you self-manage your own portfolio, so you get a little bit more hands-on, dealing with your tenants direct. And that, if I didn't have Rethink Investing, I'd probably do that. Like I used to self-manage, a lot of my properties, and, it was kind of fun talking to the tenants, getting a bit more hands-on with the renovations and stuff like that. I wouldn't do it now because it's just a time constraint. But, if I'm a 75-year-old guy just ticking around with not much else to do, like, going to talk to your commercial tenants would probably, you'd probably strategically buy them on the Gold Coast or, pretty parts of the country, or, so you just got somewhere to go, and then that's what a few of my investors have done. And it's, they're not working, but they're sort of still involved.
Well, it's life design, right? Like, if you get to a point where you go, I've got to drive to such to go, and so I'm working, inverted commas. But this is it. And to be fair, this sort of myth of retirement, which I think is a myth. I think a lot of people frame it as in, and I think there's two streams to it. Also, you get a job, a profession or a job, but you're a salaried worker all your life, and you work until you're 65, or I don't even know what the retirement age is now, 70, right? And then you retire. Then you live on your pension. You've paid your house off by that point in time, and you probably don't need to work. Like you just stop working, you just retired, and you do what retired people do, golf and whatnot. But then I think the other stream is if you're an active participant in sculpting wealth generation, i.e. you weren't a salary job, you were a business owner, or you worked in business, and then you also simultaneously with that, and you would see it a lot, you're investing in property and creating assets in conjunction with your business ventures. And they always say, Scott, make your money in business and park it in property. I think that sort of has merit, or make your money in business and park it in asset class number X. So you find the people that go down that pathway never actually retire. They're always tinkering and dabbling and working on something. There's the next deal, there's the next opportunity, there's, working. And you might be hanging out at the coffee shop with your mates and skulking around the beach, sort of working on your tan, but you're always going to be working probably until the day you sort of get put in a box and put 6 feet under. And they're the two sort of main streams. I think that's available to most people. I guess you get to make the choice which pathway you want to go in life. And what I find, even for people who, Scott, might be a PAYG employee who have a job, whatever that is, having a property investment portfolio is like their business. It gives them control that they wouldn't necessarily have inside of their working life, where they can craft their own venture. Is that the sort of the makeup of your client base, sort of those two main streams, or are they mainly more the business owner type people?
Oh, look, it's probably 50-50 split. So I've got a lot of clients, like you said it perfectly, Phil. They've got their job, which funds their portfolio, that gives them the loan. So a pay-as-you-go job is, it is literally the best thing for bank loans. So you don't want to give that up quickly, because that does facilitate most of what we talk about today. But at some point, the portfolio, if you set it up right, will outgrow you. And this is where commercial, well, for me, it definitely outgrowed my income, because the income from the properties were just getting larger and larger, and mine was fixed. And that's, it gives you freedom. It gives you confidence that, your job's not your only thing in your life. It is like just creating a business. And that's the best way to look at it. Your portfolio is your business. That's going to be there when you're not working. And then the other side is business owners who are making their money. And that could be anywhere from like a developer to, there's a lot of IT professionals out there that have that one big hit where they sell their business for a huge amount of money. And it's interesting you're talking about that lifestyle by design, because these guys sometimes can be like a one-hit wonder with their big IT company, and then they're so hungry for that taste of another big success again. Their portfolio is something, but I can tell you what, that's still not going to satisfy them. They want another big, create a new company, and the search goes on. So the property portfolio facilitates that search while they're not making their next, online booking company or whatever it ends up being. So the portfolio it's always a constant in the background. It's safeguarding your wealth, and that's how I look at property. It's there no matter what, and even if it comes off 20% because there's a recession, there's going to be other parts of the economy that get hurt a lot more in that example. So, yeah, the portfolio and that lifestyle design is exactly what I see as well.
Just pick up a point you made there around these people who get a big Hail Mary and they create a company, generate a crap load of money around it, and then they get the hunger, right? Do you reckon it's really hard to repeat? Like, people get it done once right and they might luck in, luck out, whatever you want to call it, or they're just super smart. It's not very often you see people repeat that, right? It's normally a one-off instance.
Without generalizing, but I've seen many of my clients. It does always seem to be that one big hit generally, and then the search goes on. So it doesn't mean that they're not going to hit it again. But I come from a very different background of wealth creation. Like, my parents are accountants and all that kind of stuff. So my way of building wealth is the slow and methodical and almost boring kind of accumulation type way of building wealth. So I find it interesting how you can do it instantly through whether it's cryptocurrencies or some kind of IT company that gets valued 30 times its real revenue. Like, that to me is crazy, but that's what happens in this world. And, it's like winning a lottery ticket. You're going to try win it again, I guess. And that's where I guess these guys will always be on that hunt for the next one. And it's an interesting way of building wealth, very different from my background, but it's much quicker, I guess, if it works for you.
Yeah, it is. And the thing is that you want to be doing all this simultaneously. Try and get the Hail Mary, but also doing the methodical stuff in the background. But again, it's horses, four courses.
You'd be one of those guys, Phil, with all your IT companies. You'd be ready for the big sale,
mate. No, I'm just a bloke. I'm just a podcaster, mate. I'm just a guy here who likes talking to people. If someone wants to come and, I don't know. Hey, I saw the numbers, by the way. So it's just, I don't know, talking myself up, but I think we're sort of like over 130,000 downloads a month on Smart Property Investment podcast network, which is pretty significant. If anyone wants to advertise on that, come and tell me. Happy to give you access to this great group of people. But I get a real kick out of that.
Getting ready for a sale, mate. Sell the 30x the podcast.
30 times the podcast. There you go. Well, it's the smart money at the moment. But no, I'd have to do it because I just like talking about property. And so I think someone needs to. So, but that said, also there's 1,000 property podcasts out there now. None of them really as good as this one. But on that point, though, if you've got to listen to one other property podcast, listen to Ben and Bryce over at the Property Couch. Those guys, very different podcasts, good operators. It's just really us and them have been stalwarts. We always dominate the rankings for the podcast, but you get two very different themes there. And obviously also Inside Commercial Property. While I'm at it, all the other great podcasts on the Property Investment Podcast Network, Investing Insights of the Right Property Group is another great one. I'm sure you listen to that, Scott. Anyway, there's a small plug. Go and listen to it right now. Now, I've got some questions here I want to get stuck into, seeing that you are the king of commercial property.
Calm down, mate.
Yeah, I'll have to have a chat with them. Okay, here it is. If you had to pick one style of asset in commercial sector and you could only invest in that type of asset for the rest of your life, what would it be and why?
Oh, mate, I'm going to be absolutely on the fence and disappoint you. I just would never buy one style of investment. I think, no matter what your budget, you always want to mix it up. But I'll use some recent examples. Like I've bought a small shopping center and an industrial property. I think small shopping centers are going to have an incredible 2022 ahead as foot traffic goes up. But even in 2020 and 2021, a supermarket did well, a medical center did well. These are the types of things you'll find in these small shopping centers. That, to me, is a really good intergenerational asset that you can pass on to your kids and they're going to be happy with it. It's freehold, it's large, it's diverse tenancy mix. That's a pretty good industry to stick your money in if you had one shot at it. But right now, even hotter than that is industrial. So industrial property, there's dead set not enough of it in the country. It's going for record prices. The tenants are desperate for a good quality building in a good area. And as everything keeps getting sold online and transported, the pressure on industrial needs in this country will remain. So I think it's just all about the quality of the individual asset, and then you don't generalize too much. But yeah, I think again, another one like some types of fast food would be another one. You just close your eyes and know that's probably going to do pretty well over decades, but you're going to pay for that up front because the yields are very low. So it's a very, very hard question to answer, and it's almost like saying pick one suburb in Resi to invest in for the rest of your life. You couldn't really do that in reality.
As expected, that was the answer that all diplomatic people would give. So I'm going to make it a lot easier with this next question. If you had to pick a KFC or a petrol station, which one are you going to buy as an investor?
The KFC, mate.
Is that because you love the Colonel?
I actually, that was my last purchase, to be honest, a KFC. And
did you buy a KFC, did you?
Yeah, but it had a Hungry Jack's on it too. So it was sort of like, I called up the Collins Food Group, and just asked them how business is, how that particular shop was going. And look, they're having record years. COVID was very friendly to them. If you're in certain markets, you've got, it's almost just like a 50-year window of success. Like these businesses, like the fast food giants, they've been around for a very long time. And if they did go vacant and they are in a really well located area, there is another brand of food, drive-through style, that will probably pop up and take over. I know they're very territorial over these areas, like wherever you see a KFC, there's a Macca's nearby. KFC and Hungry Jack's tend to pair up because one's a chicken, one's a beef style, thing. There's new entrants coming in, like there's a lot more Taco Bells and a lot more Guzman Gomez is popping up. So like, it's not only suited for that one property, but if you really want to be critical on that asset class, it still has a higher releasing risk than, say, an industrial warehouse would, because you're not dealing with the same
single use,
number
really,
of tenants.
isn't it? Like you've got to put another fast food joint in there, and you only drive around town, and you can still look at a building and go, "Oh, I bet you once upon a time that was a Pizza Hut." Remember those? Like they're so unique in their structure. So can you give me any insights on the KFC that you bought? So you bought a KFC in not the business, but the property, so the buildings and the car parks and all the sort of crap around it. Regional, rural sort of location, which state?
Brisbane. Brisbane. It's about sort of 35 minutes out from the CBD, and there's a little bit of land to develop on it. So it's all kind of it's just a long-term play. The yield was 5.9%, which is pretty good. Like I put it under contract back in April. I remember it was literally under contract for 6 months because there was some DA conditions I had to meet just before so I put a put call option on the sale just to secure it while they sorted their stuff out on the ground, and then it was all sorted. So it was a long time under contract. The market moved a bit in that time. So KFCs are transacting at probably an average of 3.5 to 4% across the country. So yeah, there's a bit of upside in it if there's a reval, but yeah, look, that's just a safe bet. And to my clients, 5.9% is very low. Like we don't go under 6% often. So we like, the main message is like there's got to be a minimum yield people accept, because you've got to factor in increased rates and whatnot. But remember, rates are going to, as they grow, there's also inflation, which is going to push your rents up and stuff like that. So your rents will grow over time, and that's how you should look at it. But yeah, look, most of my clients are hitting 6.5 net yields, and probably the cheaper price points were sort of just under 6% for a capital city. So they're good numbers considering most people are getting bank loans at a sub 3% interest rate still. So there's good margin in the debt.
So this, where you've bought, it's got a KFC and a Hungry Jack's on at the moment.
Yep.
Yeah. And was it built by the previous owner, or did someone?
Correct.
Okay. So people that developed it. So who goes about developing these things specifically? Do they sort of go to a KFC and will say, "Hey, we've got this site, we've done all the assessments, you should put a chicken shop on it. We'll build it all per your specs," and then they hold on to it, or they flog it.
Exactly. So you want terms agreed by a prospective tenant. So let's say, I don't know, any one of the brands say, "Look, we like your site. We're going to offer you a 10-year lease, 3% increases, 2 5-year options. The rent might be $200,000 per annum. You pay the outgoings and you work out your net yield, and then the build cost might be 1 to 1.5 mil for something like that, depending on the area. So that stacks up because you're probably going to get a 10 to 15% return on the development from a cash flow sense, but it's purpose built. It's done to their specs. You're just funding the project. And I'm sure there's different arrangements. Sometimes the companies themselves build it and then sell back, or you're the developer and you're doing it for them. So I guess it's different for different companies, but you wouldn't want to just go build it and then hope a tenant comes. You'd want to, heads of agreement signed prior.
And you can put another building on this block, can you? Is that probably where the upside is for you? You can get something else in. It's probably something healthy like a Subway. Not saying that KFC isn't healthy. I don't mind it.
They like grouping food joints because the more you create that kind of food center, they all feed off each other. It just creates more foot traffic or drive-through traffic in general. So, there's sometimes clauses in leases that prevent certain competition. So you've got to know the fine print of each lease because you don't want their businesses to directly compete against each other to the point where one suffers. Like sometimes they want to facilitate each other. And this is the same thing with a shopping center. You don't want to put 4 hairdressers all next to each other. You've got to mix it up because if you screw up the tenancy mix, the whole center will suffer. Yeah. So it's a very similar, thought pattern.
Okay, you happy to share how much you paid for the KFC, mate?
9.8 mil for that.
Okay,
one.
All right, it's a decent purchase.
Yeah.
Did you go and taste the chicken, and did you have a burger at the Hungry Jack's while you went up there to do your due diligence?
I did. I literally. This is how silly I was. I love fast food, and I don't eat much of it. But that day I had KFC and Hungry Jack's because I just wanted to sit in both of the shops, and it was good. It was just like any other shop. I really got nothing out of it. I tried to talk to the guy, and look, interestingly, he did say, look, we're getting busier and busier. And then, so I got really good news stories just from this manager of the KFC, but then the Hungry Jack's, they wouldn't say anything. So it was sort of.
Had no idea that you were the guy looking to buy the joint.
No, and you don't want to disclose that either. But the real due diligence, and this is what we do for our clients, is we try call up the head offices of these companies. They're all owned by certain individuals. And if I want to find the, success without knowing the exact numbers, and sometimes you can get them, of a Hungry Jack's in any area, we know who to talk to. And there was one I was looking at in New South Wales, and I won't name the town just out of respect, but it was getting bypassed. And I literally got told on the phone not to touch that investment because it was a time bomb. And I really wanted to buy that, for a client or even myself. It was literally a, New South Wales 6% type arrangement. It was a great deal, but it was getting bypassed. So that would have been a scary proposition because what would happen to that investment after? We don't know.
Yeah. And you only need to look at, you talk about intergenerational assets. Fast food businesses are great land bankers as well. I only think about where I grew up out Blacktown in New South Wales, out the western suburbs, and there was a Macca's on the corner of Main Street and Sunny Holt Road, probably from the early 80s, like one of the original Macca's. And then sort of come early 2000s, a huge sort of 5-6 story apartment block is put up on it. Someone's done very well there. They've bought the land cheap, chuck a Macca's on it, sat on the land, made some bucks out of the burger. And I think it was probably a company-owned one rather than a franchise one. They've done very, very well. And that's the play that continues. A lot of people say, McDonald's is a burger business. And they go, no, it's actually a property company. They just hold on to assets and put burger joints on them. But outside of the scope of this particular chat, but that's interesting sort of case study there of the KFC joint you bought in Brisbane. We've got another break, Scott. When we come back, a couple more questions I want to run past you back in a moment.
Are you wondering where to buy an investment property right now? Why not let Buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. Now, Scott, a question here. At what stage should you use a broker when investing in commercial property?
Oh, mortgage broker, day one. I think a specialist mortgage broker, if they're not doing a commercial loan every day of the week, they're probably not the guy for you. It's a very specialized industry because they've got different avenues through the banks, and a good broker, because obviously we work with countless numbers of brokers because clients have their own ones. And the first giveaway is the time needed for approval. If your mortgage broker says, I need minimum 42 days for finance and all that kind of stuff for a lease stock loan, they're probably learning on the job somewhat, or they're only dealing with one bank that said that's the timeline. Like, to give you an idea, we always put offers subject to 28 days finance, and we don't need extensions. I'd probably 20% of the time we ask for extensions on that. So 80% of people are getting loans done within 28 days of a contract. Fine. And it's because we work with good brokers, and they'll tell you the banks to go through. There's different lease stock arrangements. There's different interest rates out there. A good broker will even negotiate a higher leverage for you. So the bank might say minimum 60% on this shopping center because it's regional. Good broker can turn that to 65 straight up, maybe even 70 if depending on who they know and the debt level and the overall deal strength as well. So definitely consider the mortgage brokers and have a specialist in that field, and don't feel guilty leaving your current broker because you don't have to leave or take all the resi loans off them. You keep them with them, but maybe just look after yourself on the commercial side.
Yeah, fair enough. Another question here. So WeWork, so shared office spaces, would you be investing in that sort of stuff?
Look, no, just because it's a high value type purchase. And look, I like owning, or put it this way, it's very hard for me, even when there's a good tenant, to get a client to commit to us plus $3 million purchase if it's not freehold. So sub $3 million free strata complexes, all that is perfectly fine because you're going to be in a blue chip area. But the WeWorks of the world are, generally a pretty high value type purchase, and you're owning a floor of a building. And I don't know, if you're spending that type of money, it's a little bit hard to kind of get your head around just to offer floor space. But doesn't mean it's a bad bet. It's just probably something that's a little bit outside my normal scope. And I think there's more interesting options out there for that type of money.
And I think that they're sort of quite pressured. They'll tell you otherwise. But we saw, I think it was early last year, at the start of sort of the COVID pandemic, one of the big shared workplaces just went to the wall, right? And I think now the idea of like, we can't afford our own office, so therefore we'll use shared workspace. I think shared workspaces now is sitting in front of your computer at home somewhere on the beach. So whether or not the appetite for those type of assets and people wanting to actually work within them moving forward, jury's out on it, and maybe we can pick that up at some point in time. Last question, Scott, office spaces as an investment in Australian capital cities, yes or no right now? Look,
question mark. I think we quoted on the Inside Commercial podcast that Bernard Salt, He's very vocal about these types of things, and he's saying pre-COVID, this is over a 20-year average period, there was a 5% flexible work arrangement with staff, and now he's predicting it's going to be 10 to 15 moving forward. So that's triple. Like, it's still a low percentage, but still triple the amount of people with flexible work arrangements. So how is that going to affect the leasing market? It will depend on, probably the main thing is immigration levels. So what the unique thing about Australia is we can change our entire economy by just letting more people in. And that means butts on seats in offices or more drivers, or, that's the thing that will potentially change everything. So all these little stats out there and people's feelings of office and all that, it will be totally overridden by what happens with immigration, because they generally will pile into Sydney, Melbourne, Brisbane, and then Perth and Adelaide as probably secondary places. So I think there's short-term leasing risk, but the square metre rates for sales are still hitting record levels off the back of low interest rates. So there's no real opportunity to buy well, but it is, historically been viewed as a premium product. So that, it's not like it's a dud product either. It's just, again, I think there's potentially other opportunities out there.
Good, mate. Well, covered a lot of ground there. I'm feeling hungry actually at the moment after chatting about KFC, which I reckon I only have KFC once a year, and it's normally when I'm rolling with a hangover of like epic proportions. You've got to get a bit of the KFC into you. So let's hope that's some far away from me. But no, it's good, Scott. Thanks for sharing those insights. It's good to get you on the Smart Property Investment Show. Bit of a different way of doing it than our podcast Inside Commercial Property, which you can listen to on the Property Investment Podcast Network, which you probably listen to right now. Go and check it out, or you can listen directly to search for Inside Commercial Property. Scott, thanks for your time today, mate.
Thank you, mate. Always good to speak with you.
Nice one. Scott O'Neill, Rethink Investing. Go and check those guys out. If you're needing some help buying commercial property, you can probably contact them through the website. It's probably the easiest way. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ. Remember, just keep an eye out. There's some cool stuff in the background bubbling away that I'm pretty excited about. I just need to tick off a few things before I unveil it to you all. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.